Newbie, are you around so that I can explain why? First of all, I don't know why you're trading live because you were specifically told don't do that, but you did it anyway. So you took a gamble on Google because you thought it was going to go higher, and now you're trying to close out a trade, but you're not really sure what happens with a butterfly. So all the reasons why you should not be trading live until you are completely through the curriculum. You got me? So let me explain to you why your butterfly wasn't worth shit today. It's Friday. I'm assuming it's a Friday expiration, but regardless, you'll see from this explanation why or how butterflies work. So, as opposed to CTV, CTV, we don't buy butterflies. We buy a vertical and then we sell a vertical, which creates a butterfly, but we do it for a profit. When you buy a butterfly, you are you are actually risking the debit paid. So just as a distinction between the two, because you mentioned CTV. So CTV, we get paid to put on the butterfly. It's a very unique strategy, and it's awesome. Uh, but what you did, it looks like, is you bought a butterfly and you put it like this, and price finished right about here over maybe it was today or yesterday, and you were like, yeah, this is five wide, right? Which means it's worth 500 bucks. I'm going to close it today. Pay me. No, is would be the answer. They're not going to pay you. So let me just share with you kind of how it works. It's really very simple. Oh, was his expiration November? I thought his expiration was like this Friday. Oh, you had a month to go? So you're taking a gamble that Google's going to go higher next month. Yes, November. All right. Yeah. So I'm going to show you exactly why it didn't. So you're going to know everything you need to know about butterflies. So here's a very simple explanation. So here's a 150, 155, 160. If you were to buy this, let's just say you spent $1 to buy this. That was your cost, 100 bucks. Okay, these are all calls, and you think price is going to go up. Great. So, in order to buy this butterfly, the construction of it is you buy this call, you buy this call, and you sell two of these in the middle. That's called a butterfly because it's shaped like that, right? But when you actually bought the butterfly, you didn't buy a call and then sell two calls and then buy a call. You bought it as one structure, as a butterfly. And when you do that, let me show you something. This is called buy to open. Okay? Buy to open. You're buying to open the 160 call. The 150 strike, buy to open. And you'll notice in your platform, in fact, I'll show it to you in a minute, it says buy to open, buy to open. But you're going to short the two strikes in the middle. So you're going to sell to open. You're going to sell to open. Okay? That's how you create the butterfly. In fact, if you looked at your platform, that's what it would have said. It would have said buy to open 150 call, sell to open two minus two of the 155 calls, and buy to open the one quantity of the 160 calls. That's when you put on the trade. Okay? And when you did this, this one cost money. This one cost a little less money, but you still had, cost here. But you got paid premium for this. Sell to open. So let's say that this cost $2 for this call, right? And this up here only cost, say, $1.50 because it's more out of the money, right? So that's $3.50. Well, these strikes, maybe they were, I didn't do this right, but let's just say they were 125, right? 350. Let's say they were $1. 250. Yeah, I'll change the quantity here. Let's just say these were, let's say 175. No, that wouldn't work either. What, 350, 350. So this would have to be like 220. And this would have to be like 175. Let's see, 180, and this could be like 160. Let's see if that works. 320, 3, 4. This gives you an idea. Times two, so you get $320 from this one. This one costs you 180. This one costs you 220. So you're spending $400 on those two calls, but you're getting 320 from these. So then the total cost was only 80 cents for the butterfly. Does that make sense? Something like that? I'm just trying to get the math to work. But that's how it works, okay? You got paid premium to open it, and then you bought that and you bought that. So now let me show you what happens when you close the butterfly. This is the important part to understand. You don't just sell the butterfly for $500 if it's here. What actually happens? So watch this. If I want to close it today, Wednesday, and forget about November, even if it was a Friday expiration, right? In order to close the butterfly, watch this. Buy to open. Well, if I bought the 160 newbie, how do I close this 160 call? I bought it for whatever that price was, right? How do I close this call? Well, just make sure that this is just for newbie, not anybody else. How would I close this call? I bought it to open, so what do I have to do to close it? Yeah, exactly. So it's called sell to close the 160. Now, if price is at 155, what's the 160 worth? Is it worth anything? It might be worth a little bit of premium, maybe something. But for the most part, it's out of the money. It's not really worth much. Maybe you'll close it for 10 cents, right? And remember, when you bought the butterfly, you buy it as a butterfly. When you sell it as a butterfly. You sell the whole structure. I'm just breaking it down to show you the components. Now, the 150 newbie, you got to do the same thing there, right? Buy to open. So this one is going to be sell to close also. But this one's worth something. There's a little bit of premium, but you got $5 of value. This is why you thought you were going to get paid $500, right? So let's just say it was worth 520. $5 of real value, right? The difference between 150 and 155. You still had a little bit of premium left in it. So you sold to close, and then maybe this one had, 10 cents of premium. So you got $5.30. And you're like, pay me my 530, right? Isn't that what you were thinking? Why don't I have max profit? It's Wednesday. My expiration is Friday, but I want it now. Well, if you know something about options, which I will teach you, and you'll certainly get it from the 10 musts to master because I cover this explicitly. When you buy an option, from the date that you buy it to the date of expiration, the premium that was in part of the pricing of the options, the premium in it that's part of the cost burns off to zero. But it's not zero, newbie, until expiration date. So if you bought it Monday and this is Friday, this is Monday, can you see by Wednesday there's still some premium left? It hasn't burned completely off. Do you understand? There's still some premium left. Premium will be at zero on Friday, or in your case, November, but it's still worth something. There's still premium in the option. So guess what you have to do if you sold to open the 155s? Newbie, what do you have to do to close it? How do you close a short? There's only one way. You have to buy to close. Buy it back. So then the question is, well, okay, I'll buy it back. I got 520 bucks. Woohoo, I made my $5. How much do I have to buy it for? Oops, sorry, it's still worth like $2. There's still $2 of premium left in here, or whatever the number is, right? I'm making it up. Times two, which means it's going to cost you $4 to close these two. You got paid 520. You're gonna it's gonna cost you 400. So when you look at it, you're like, well, it cost me 80 cents. I could get 120 right now for it. So do you see now why it wasn't worth 500? Because there's still premium left. Now let's just say you didn't have November, you had Friday. Okay, Friday expiration. These numbers would be different because on Friday, well, I'll do it. Oops, I'll do like this. On Thursday, guess what? Sell to close, still zero. Sell to close, it's still 520. Well, we'll call it $5, right? Premium is not worth counting. So you still got the $5 here. But now there's less premium. Remember, I said the premium, you bought it on Monday. Here's Wednesday. Here's Thursday. Here's Friday. It'll be zero. At the end of the day, there's no premium left. It has to be at zero. That's just the way premium works. But see, there's less premium on Thursday than there was on Wednesday. Guess what? It's only a buck 50. It's only going to cost you $3. So if price went to 155 and in your case 250 and stayed there 2 days in a row, 1 day closer to expiration, right? You'd only have to spend $3 to close those two. So instead of it being worth 120, what's it worth now? Now it's worth $2 on you see? Until we get to Friday. And you wake up Friday morning and lo and behold, holy the thing is still at 155. So guess what? Sell to close? Yep, still zero. Sell to close? Yep, it's still $5. There's no premium really left. You got the whole day. But you look at this at say 10 o'clock in the morning, and holy crap, right? There's still like 30 cents a premium times two, 60 cents. So does it close Friday morning for $5? No, maybe it's 460. Maybe it's 400. Maybe it's like 350. Or you guys have seen different prices, right? And you're wondering why. It's 10 o'clock in the morning Eastern. I'm right smack in the middle. I pinned the fly. Why isn't it worth $5? Because the premium hasn't burned off yet. It'll be different at 1 o'clock. It'll probably be $20 more. It'll be different at 3 o'clock. It'll be another $20, better. Does this make sense? So if you bought a butterfly, let's say you bought it last week, and you bought a butterfly for November, don't look at the trade for another 3 or 4 weeks because it's worthless to look at because you're not going to get any kind of worthy premium decay to make that butterfly worth anywhere close to what it's worth. This is why you don't buy butterflies that far out unless you're looking for a long-term move and it's wide enough, not 5 points, it's wide enough to land somewhere in here 3, 4, 5 weeks from now. And then you just throw it on there and it's not even worth looking at till you get closer. Newbie, does this make sense? Do you see why you're not going to get paid? It's probably profitable unless you didn't buy it right. But well, it's not that they're only good at expiration, newbie. That's not true. It's because I don't know when you bought it, but was it profitable today? If you were to sell it today, I know you wouldn't have gotten 500, but would you have made a profit if you sold it today? Even maybe $10, 20, 50, whatever it is. It's probably somewhat profitable, isn't it? A little? I don't know. Depends on how much. Oh, you lost $12. Yeah, that's probably scratch. It's probably even. Yeah, so you don't close it. Then why would you do that? If this Here's another lesson for you. I hate to rub salt in the wound, but what you said as I read your alert earlier, your post earlier, I don't know when you got it. I don't know when you bought it. But what you said was you bought a Google butterfly, whatever at whatever price and wherever it was, right? Because you thought Google was going to go up. Oh, you bought it last week. Okay. So I don't know what you saw last week. That's last week. So right here. So that's Friday. That's Thursday. That's Wednesday. That's Tuesday. So maybe you bought it on Monday when it did this. I don't know. That is not a valid setup as far as I would be concerned. And then look what happened. Down, 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 down. So I don't know why you thought last week it was going to go up. But let's go with your setup. What you said was you were looking to see if price would go that price in Google would go higher. If you truly believe that, and it has in fact gone higher, why would you close it? Why would you close it for a $12 loss if you thought Google was going to go higher? And I know the answer. You bought the wrong strikes. You bought too close to the money. So it cost you too much. And now you're at the center. And so if price is going to go higher, it's going to blow through your butterfly and you're going to lose all your money. That's why you're trying to dump it now, right? I mean, that would be. Yeah, it was at 250 and you bought it 250 and you're like, okay, I'm there. Let me sell it. Doesn't work that way. So if you really liked Google, did you check the expected move in Google? Did you check previous swing highs? Did you run any Fibonacci? What made you pick 250? And if you thought it was going to go just to 250, butterfly is the wrong strategy. You should have bought a call debit spread, 240, 245. Then on today's move, and you wouldn't, and why November? Maybe, where are we? Mid October? Yeah, you put today, this Friday's expiration, you go maybe 1 week, maybe 2 weeks. You kind of see what I'm referring to here. Price was price was sitting at about 240 or whatever. 250 not a bad target if price was around two wherever it was. I don't know what it was, or I don't know if you bought it here and thought it was going to go to 250, or on the pullback you thought it was going to go up to 250. But whatever you thought, vertical would be the move. 245, 250 is pretty out of the money. So maybe you do 240, 245. It wouldn't be as cheap as the butterfly, but you'd be almost at max profit. And then you use this Friday as your expiration, or next Friday so that you don't have theta decay. Now that's the easy. This is the, with the butterfly, you want the premium to burn off, right? With a vertical, you don't, because if price stays the same, you'll lose money. So you got to really know your what strategies. So you did it on a pullback. Yeah, yeah, I see what you mean, but it really that's not a it's not really in hindsight it is, but like for instance, yeah, it did pull back. All right, I'll go with what you thought you saw, but the pullback broke the 20. So see how it holds here a little bit, ah, and then it fails. So from a technical perspective, that's not a long. That is not a long. A long would be that, like yesterday's candle up here after this, after it pulled back. You got to wait for it to prove itself. Because look at this. This is lower lows, lower highs. This thing's going down. So in order to go long, you've got to wait for it to hit the support level and then start to turn and look at other factors. Now, obviously, last week I was all about shorting because of the market conditions. That's the other thing. So you looked at Google in a bubble, did you not? So did you consider yields? Did you consider the dollar? Did you consider the VIX when you looked at this? Probably not. So you avoided the market weather. Now you got lucky that it actually moved up like this, but you avoided the market weather completely. And the analogy that I gave years ago still stands. You would not make plans to go to the beach this weekend without checking the weather first. You wouldn't make plans to go skiing without checking the snow report. Make sure there's snow there. What if you show up at Aspen and there's no snow? What are you going to do? You sit in the spa the whole week, but you wouldn't do that. You would always check the weather first. So don't look at trades in a bubble and go, you know what? I like Google. It looks like it's pulling back. I'm going to buy a butterfly. I'm just going to do that. That's like a gambler mentality. It's the wrong strategy, not quite the right setup, and you never bothered to check the overall market weather.
Thanks for watching. Hope you enjoyed this video from Trade With Me Now. Make sure to go ahead and like this video and subscribe to our channel so you make sure that you catch our next video right when it's released. Also, if you have a question or comment, please leave that in the comments section below. And of course, if you want to learn more about Trade With Me Now or join our community of profitable traders, go to tradewithmenow.com. There's also a link in the description below.